All right, so one of the most common questions I keep getting is, why do I buy my options deep in the money, at the money, in the money, etc.? A lot of times people get the wrong idea about options, and they think that options are like a bet on a stock to go to a certain price, when in reality, I mean, that is how some people use them, but how I use them is to leverage my trades. So for example, take MARA. It started cranking earlier today at around $47. I think I paid about $250 for the $47 contract. Now, why would I do that? So if you look at these contracts, we'll just use the prices that are on there right now. All right, so look at the $47 contract, for example. All right. What you'll see is, for about $335, I get access to 100 shares. That means I'm just trying to have MARA go to 50. Keep it simple. We'll just say to 50. If I spend $3, I'm going to say to 50. Simple math that way, okay? So I'm just having it go to 50, and then I'm happy. Then I broke even, because the $300 that I put in gets me to 50, $1 per share. It's a 100-share contract, right? Sorry, I got a lot of words going on. Now, let's just do a different example. Let's do a $51 call. Let's just pretend like I spent $2 on it, right, per share. So in that case, for $100 extra, this stock now has to get to 53. However, now if it gets to 53, I break even. If I spend $200 on a $51 contract and it gets to 53, I break even. However, if I spent the extra $100, $300 on a $47 contract and it got to 53, I'd make $600. So the question becomes, if you expect a stock to go up by X amount, let's just say 10%, all right? If you expect this stock to go up by 10%, and you had a $51 option that you spent $200 on, or a $50 option that you spent $200 on, you're going to come close to breaking even. You're probably going to lose some money, all right? If you spend the extra $100, which is not a lot more, to get access to an extra $300 worth of value, because it's $3 cheaper, the 47 than the 50, just by spending that extra $100, you get $300 more of value guaranteed inside that contract. So it's called intrinsic value when it's already priced in. So in reality, if I'm buying that $47 call for $300 when it's already $48, I'm really only spending $200 that isn't already in the money. That's really a risk, you know? So the risk is lower, the profit's higher. So that's why I always buy in the money or at the money. At the money only if it's something that I believe the percentages are going to crank really high and the premiums are already high.